Most people think silver is a relic, a thing your grandmother left in a drawer, a coin store obsession, a nervous man's hedge against the end of the world. I do not. I think silver is one of those assets the public ignores right up until the structure underneath it changes so much that the old story stops working and the price begins telling a different one. That is the first thing I would want you to understand. This story is not really about silver. It is about what happens when the rule book changes quietly while the crowd is staring somewhere else. The public watches headlines, the serious money watches plumbing, the public watches speeches, the serious money watches inventory, funding costs, classifications, settlement mechanics, and cross-market ratios. The public wants a loud signal. The serious money knows the largest moves often begin with silent rearrangements in the background. That is why I am interested here. Not because silver is fashionable, because almost every important repricing in markets begins the same way. A hidden pressure builds, a rule shifts, a constraint appears, a cost changes, a flow tightens, the old behavior becomes more expensive, the new behavior becomes more necessary. Then the market does what it always does when the floor moves underneath it. It pretends nothing has changed until suddenly it cannot pretend any longer. That is the setup. And if you want to understand it clearly, you have to stop thinking in price first. Price is the last confession. I prefer ratios. Ratios strip away some of the drama and let you compare one thing against another thing. Honestly, when I want to know whether silver is expensive or cheap in the way that matters, I do not begin with dollars. I begin by asking what silver is worth compared to productive risk itself. What is silver worth compared to the stock market? That ratio tells a cleaner story than the headline price ever will. Because a price can rise simply because money is getting weaker, a ratio is harder to flatter. If silver is rising while stocks are rising faster, that is one message. If silver is deeply cheap relative to stocks, that is another. And when the silver to SP ratio gets crushed to the kind of levels that historically preceded major multi-year reversals, I pay attention. Not because history repeats perfectly, because markets rarely invent from nothing. They rhyme through structure. That is a phrase people overuse, but they do not usually understand it. History rhymes because humans keep responding to constraints in recognizably similar ways. When an asset becomes extremely cheap relative to a broad risk asset, and then the underlying supply mechanics tighten while the financial rules around that asset also change. The odds shift, not certainty. Odds, that is enough for me. Most people want guarantees in markets. That is why they lose money. They wait for certainty. And by the time certainty arrives, the easy move is over. The price is different. And the emotional cost of entering has risen. I am not looking for certainty. I am looking for asymmetry created by quiet structural changes. Silver has that shape. And the reason it has that shape is not what most retail investors think. The retail investor usually thinks in slogans. Precious metals are up. The Fed is printing. Industrial demand is strong. China is buying. The dollar is weak. Those things matter. But they are not the deepest layer. The deepest layer is always the rule book. Who is allowed to hold what? At what cost? With what reserve treatment? Against what form of collateral? In what quantity? Under what export regime? Against what stock of immediately deliverable metal? That is where the real story begins. So let me tell you the version I care about. For years, a large portion of the silver market operated through paper claims and unallocated exposure. Promises, not always bars. Contracts, not always immediate metal. A financialized layer thick enough that many people came to believe it was the real market rather than just a market sitting on top of the real one. That matters, because paper supply can suppress urgency if enough promises can be created around a scarce thing. The scarce thing feels less scarce, right, up until the moment the system starts caring more about the actual thing than the promises describing it. That is exactly the kind of transition I watch for. And when regulation raises the cost of carrying unallocated exposure, the economics change. That is what Basel III and the net stable funding ratio represent in practical terms for this story. Most people hear a phrase like that and their eyes close. That is a mistake. Boring language is where serious money hides its intentions, when a regulation makes it more expensive for a bank to hold or finance certain forms of paper precious metals exposure. The bank's behavior changes. A trade that was once convenient becomes capital intensive. A profit center becomes less attractive. A cheap way to provide market liquidity becomes more expensive. That does not make for exciting television, but it changes incentives. And incentives are the real engine of markets. You can tell retail investors a story. You cannot talk a bank out of a changed cost structure. That is why I think this matters. The old paper, heavy silver world depended on a certain economic comfort. If holding unallocated claims becomes more painful, then the appetite to run enormous books against limited physical supply weakens. That does not mean the market instantly breaks. It means the cushion gets thinner. It means real metal matters more. It means the distance between paper and physical can no longer be treated as harmless abstraction forever. Once you understand that, another development becomes much more important: China. Not as a slogan, as a bottleneck. When a country that handles a huge share of refined silver exports begins tightening the channel through which silver leaves its borders, that is not merely a local administrative curiosity. That is a global supply event dressed in bureaucratic clothing. Most people ignore export controls because they sound technical. I like technical things because they eventually become emotional for everyone else. If China tightens silver exports through licensing, fewer firms can move the metal, friction rises. Global buyers compete harder. Domestic priorities matter more. The world outside China is no longer sourcing from the same open pipeline it thought it had. Again, this is not a loud headline in the way a war headline is loud. But markets do not only move on noise, they move on friction. A tax here, a rule there, a permit delay, a capital cost increase, a shipping reroute, an export license, a reserve charge, a classification shift. Enough of those stacked together and the market's surface can look calm while the structure underneath is being tightened like a wire. That is the kind of tightening I care about. Then there is demand. And here again, most people think too crudely. They hear industrial demand and imagine a vague upward line. That is not how to think about it. Think instead in terms of inevitability. Silver is not only a store of value asset, it is an industrial conductor tied directly into the physical economy of electricity, electronics, solar, data infrastructure, medical devices, and next-generation manufacturing. That changes the profile of the market. Gold can be hated and still remain gold. Silver can be ignored by investors and still get consumed by factories. That is a very different dynamic. If 1 in 5 ounces of annual silver supply is effectively going into solar, and if electric vehicles, high-efficiency electronics, grid hardware, and data infrastructure all keep demanding conductivity and reliability, then the industrial floor under silver is not a theoretical talking point. It becomes a real drain on available supply. This matters because industrial demand behaves differently from speculative demand. Speculators can change their minds in an afternoon. Factories cannot redesign a whole technology stack because a metal became inconvenient. That does not make silver invincible. It makes the balance tighter, and markets with tight balances become more violent. When something shifts, that is why I keep returning to inventory. COMEX is not the whole silver universe, but it is one of the places where stress becomes visible early enough for disciplined people to learn from it. When registered inventories fall, when the amount of clearly deliverable metal declines, when eligible and registered start mattering to more than a niche group of specialists. The public is usually still asleep. It hears none of this. It is busy with stocks, politics, central banks, and whatever loud thing social media is currently chewing on. That is fine. The public is often useful because it looks everywhere except where the mechanical strain is forming. What matters is not whether COMEX literally runs out tomorrow morning. That is cartoon thinking. What matters is whether the system becomes more sensitive to demand shocks because the available float is thinner, because industrial pull is stronger, because paper mechanisms are more constrained, and because alternative export channels are less forgiving. That is the real diagnosis. A tighter market does not need to run out to move violently. It only needs to become less elastic. That is when prices stop drifting and begin jumping. Now, if you put all of this together, you can see why I dislike treating silver as a simple commodity call. It is not just I think silver goes up. That is a child's version of the story. The adult version is this. Silver is sitting at the intersection of 3 changing systems: the financial system, where regulation is making paper-heavy behavior less attractive, the industrial system, where real-world consumption keeps increasing, and the geopolitical system, where a key export channel is no longer as open and frictionless as before. That is not a normal setup. That is a compression setup. And when an asset sits inside a compression setup, while also being historically cheap relative to a broad risk benchmark like the SP 500, I stop thinking in terms of headlines and start thinking in terms of regime shifts. That is the phrase I want you to remember, regime shift, because that is what quiet rule changes really do. They do not announce the end of an old regime with fireworks. They simply make the old regime more expensive to continue. Then gradually at first and suddenly later, the market begins behaving as though reality had changed overnight. In truth, it changed much earlier. People just did not bother reading the footnotes. That is why ratios matter so much. The silver to SPY ratio is one of my preferred reality checks in this kind of story because it answers a humiliatingly simple question. How cheap is silver compared with the thing everyone loves owning? If silver is deeply hated or ignored relative to equities and the ratio is sitting near extreme historical lows, that does not guarantee a reversal. It simply tells you expectations are already deeply one-sided. That is valuable. One of the most profitable conditions in markets is when a structure is improving while expectations remain frozen in the old story. That is where asymmetry lives. And asymmetry is what serious investors are paid to recognize. Now, none of this means I would tell anyone to bet the farm on silver. In fact, the opposite. One of the reasons silver gets people into trouble is that it can behave brilliantly and violently in both directions. It is more volatile than gold. It is more emotional than many investors realize. It can produce thrilling upward runs and stomach-turning collapses. The very thing that makes it powerful in a structural reversal also makes it painful if you size it badly. That is why I think of it as a rule book asset, not a religion asset. You do not worship it, you frame it, you size it, you monitor it, you respect its role inside a broader capital structure. That brings me to what I think is the most useful part of the whole story. The 3, signal framework. I like frameworks because they keep people from turning a valid idea into an emotional hobby. The first signal is the silver to SP ratio. Where is it relative to long-term history? Not where would you like it to be. Not where some silver enthusiast says it should be. Where is it actually? If the ratio is stretched toward major historical lows, that tells you silver is very cheap relative to stocks. That is condition 1. The second signal is supply-demand balance, not opinions. Balance is the market in deficit. Is more silver being consumed than mined and recycled into available supply? And is that deficit becoming a recurring condition rather than a one-off weather event in the data? If the answer is yes. Then the second layer of the setup strengthens. The third signal is rule, book pressure, are regulations, classifications, reserve treatments, export regimes, or legal changes making it harder to maintain the old paper. Heavy, friction, light system. This is the signal almost nobody watches because it sounds boring right up until it changes the economics underneath the whole market. When all 3 line up, the setup becomes much more interesting. Cheap relative to stocks, tight in physical balance. Rule book shifting against the old easy paper regime. That is not destiny. That is a serious framework. And frameworks are what keep you from becoming one more investor telling himself stories while calling it conviction. This is also why I think the source material is right about one deeper thing. The real money is rarely made by people who only understand the visible layer. It is made by people who understand the invisible system underneath the visible layer. That is true in silver. It is true in bonds. It is true in housing. It is true in banking. It is true in technology. The market is the surface. The rule book is the structure. And if you understand the structure earlier than the crowd, you do not need to be louder than the crowd. You just need to be positioned before the crowd discovers what changed. Now let me say something equally important. Do not build your whole financial life around a single dramatic thesis. That is not strength. That is fragility disguised as conviction. Silver can be part of a broader architecture. It cannot be your substitute for an architecture. You still need productive assets. You still need liquidity. You still need cash flow. You still need a survivable plan if the market takes longer than you hope to reward your diagnosis. This is one of the great errors enthusiasts make. They become so correct about one structural story that they stop respecting life's ordinary demands. Bills continue, families continue, emergencies continue. A correct thesis carried in the wrong size can still injure you. That is why I think in layers, core productive ownership first, stability second, optionality third, then targeted asymmetry, silver in my view, belongs in that asymmetry layer, especially when the rule book, the demand data, and the valuation relationship all start pointing in the same direction. What I would not do is treat it as a toy. I would not swing in and out because someone on television made a face. I would not assume every dip is manipulation and every rally is destiny, I would not expect linearity, and I would absolutely not own it in a size that prevents me from sleeping through the kind of drawdown silver has historically been capable of producing. You cannot say you understand an asset if you only understand its upside. That is adolescent thinking. Maturity means you understand what it can do to you when you are early, when you are wrong, or when you are merely right on the structure and wrong on the timing. That humility will protect you. And humility is the proper emotional posture for a market like this one. Now let me compress the whole story into the simplest possible form. Silver matters right now, not because the public suddenly loves it. It matters because the old system that made silver easy to ignore is quietly becoming less stable. Paper mechanisms are more expensive to support. Physical flows are tighter. China has become more controlling at the export level. Industrial demand is more structurally embedded. Inventory sensitivity is rising and relative to stocks. Silver is still sitting in the kind of valuation posture that has historically preceded violent reversals. That is the map, not a promise. A map, and maps are what adults use when they stop gambling. If I had to write a contract with my future self around this story, it would say this: I will not wait for the evening news to tell me what the rule book has already changed. I will not look only at price when ratios tell the cleaner truth. I will not confuse an industrially essential metal with a sleepy relic just because the crowd is distracted. I will monitor value relative to stocks, deficits relative to supply, and regulation relative to the old paper system. I will size any exposure with respect for silver. Volatility, not with fantasies of certainty. I will treat silver as a strategic asymmetry, not a financial religion, and I will remember that the biggest repricings in markets almost always start the same way, quietly. That is the real lesson. Not that silver must explode tomorrow, but that the floor underneath it may already have moved while most people are still staring at the ceiling. And when that happens, the move is never really sudden. It only feels sudden to the people who are not watching the structure.